The most important thing for us is what we call business quality. So we look for businesses that, one, we can predict what they're going to look like with a high degree of confidence over a long period of time. So the value of any financial asset is the present value of the cash the business will generate over its life. If you can't predict what the business looks like 5 years, 10 years from now, 15 years from now, you really can't figure out what it's worth. So we try to find businesses that are first predictable. And then in order for the business to be predictable, it also has to be protected from the various forces in the world. The hardest thing to do as an investor is to figure out or determine, is this a business that's going to be disrupted by two Citadel students working in a garage, or is it a business that's going to survive whatever technological changes occur, AI, et cetera? That's the hardest part about investing. But once you've found a business that meets that criteria, we sort of have a library of these kind of companies, and then we track them on a regular basis. And even the best businesses in the world, at various times, sometimes for reasons completely unrelated to the business, become available at really cheap prices, right? Every stock on the S&P went down, something like 10 or more percent in the couple of days after the tariff announcement. Some businesses are materially affected by tariffs, others are not. If you do sufficient work, you know the business as well, because of the volatility in markets, every once in a while, a really great company becomes available at a really cheap price. And we just wait for those moments. And so it's not like we're figuring it out before other people. It's just that we know a meaningful number of companies. When the stock prices move significantly, become a lot cheaper, we update our work. If it's still as interesting as we thought before, now available at an interesting price, we buy. There aren't that many companies that meet that description that are available at a cheap price. So the other thing we do is we just concentrate, meaning we own 10 things. Most investors own, a typical mutual fund might own 100 securities. Most investors make the mistake of owning too many things. And the reason for that is diversification protects you from ignorance, right? If you don't know what you're doing, just do a lot of things, right? Most business people know a ton about their own business and they're super concentrated in their own business. I mean, if you look through the Forbes 400, the wealthiest people in the country made their money generally in one company. They had a portfolio of one. I mean, that's an incredible degree of concentration, right? So, 10, 12 stocks is more than adequate diversification if you're investing in really high quality companies. And so the combination of concentration, kind of doing our homework and being good at, figuring out through the risk of disruption has enabled us to be successful.
You added a stock today.
We added a stock today. Actually, we bought a position, bought a little under 20% of Hertz. And what attracted it, so most of our investments are large cap, dominant companies with strong balance sheets, kind of long-term durable growth companies, very difficult to disrupt. And we put 10, 15% of our assets in those. Occasionally we come across an investment that we call a mispriced probabilistic investment, where there's a much bigger risk that we lose money, but there's a much larger potential for gain. And Hertz is sort of an example of that. So Hertz, basically, the story here is Hertz went bankrupt during COVID because people stopped renting cars and the company had a fair amount of leverage. It came out of bankruptcy like General Growth, our bad, we missed it, where the equity basically remained intact. And then the management team made in retrospect, strategic decision that was a disaster, which they decided to buy 100,000 Teslas and have an EV fleet. Tesla's an amazing car. They thought the market would differentiate them from their competitors, but they underestimated a few things. One, how to keep the car, you go to a gas station, you fill up the car in 3 minutes. Well, when the guy brings the Tesla back, it takes a lot longer for the car to kind of recharge. Also, the consumer, a lot of consumers hadn't driven a Tesla before. It's a little bit different of a kind of a driving experience. People worry about running out of, power, et cetera. And so that was a problem, and they realized it. And they decided they wanted to shrink their Tesla fleet, but then Elon materially reduced the price of the Model, Y, and as a result, the residual values of Teslas went down. And Hertz's business has sort of two components. One component is they own 500,000 cars, and they finance with basically 100% financing that 500,000 cars with, these securitized loans. And the way it works is if residual values of cars go down, Hertz has to put more money into this securitization to keep it sort of meet the various kind of standards. Otherwise, the lenders can liquidate the cars, which of course would be a disaster for the company. So when the residual value of Teslas went down, they had to borrow a lot of money in the business to put more money into the securitization. And that levered up the company, bit of mismanagement coupled with this problem, and the stock got, crushed, down 90%. What intrigued us was a couple of things. So one, a new management team had come in to run the company that seemed very capable, was doing the right things. The second thing is that Trump was talking about tariffs, auto tariffs. What's interesting about tariffs in the auto industry is you don't charge tariffs on used cars. And so if the price of cars is going to go up by 25% because of tariffs, the residual value of cars is going to go up. So all of a sudden, there are 500,000 cars, the residual value is going to be higher. And so this securitization, which consumed a lot of cash, well, the good news is that when residual values are higher, you can actually take cash out of the securitized portion of the business. And they had worked them through basically the big kind of one-time loss on the Teslas. And our view is they're going to come out of this, start generating more profits. And because this company is so levered, the Hertz stock is almost like an option, like a long-term option on this sort of turnaround. And you're paying $1 billion for the company, and there's like $12 billion of debt against the cars. There's like $4 billion of debt against the company, and the equity reminds me a bit like the General Growth kind of equity. And so we bought 20% of the company. There's a 60% smart shareholder that's trying to fix it. It's for us a relatively small investment. We invested about $230 million, so it's like a 2% or so, a little under a 2% position, but it can be a 7 or 10x over the next 3, 4, 5 years. So, but you can lose your money too, because there's a lot of debt, and the risk is that if in fact the whole tariff thing puts us into a deep dark recession, that's not good for rental cars. So, caveat emptor.